Hey, welcome to the Guaranteed Retirement Guy Show. My name is John Stevenson, and we're going to be talking about the best hybrid annuities for growth and income. Okay, so you want growth and you want income. Okay, you can get both. You just have to realize you might suffer on one or the other, because a lot of times they'll usually focus on one versus the other. And so if you want growth, okay, with an income annuity, you can get both, but maybe the income will be much, much higher and the growth will be much, much lower. Okay, and vice versa. Maybe if you're okay with lower lifetime income, but higher growth, then we can kind of go in the middle. So I'm going to show my screen. I'm going to show you exactly what the best options are using fixed index annuities, and we'll dive into some MYGAs as well, the fixed rate products. And just what my recommendations are for if you're looking for growth and income. Usually what I recommend is people set these up separately. You've got ones that'll give you growth and income, but they give you mostly income. And then you got ones that focus solely on growth. That's usually what I recommend. It just depends on your strategy, how much money you have, how much money you want to allocate towards annuities. I always tell people use just the amount that you need for an annuity and no more than that. So you can leave the rest in whatever your other growth, if you want to throw it in the stock market, you can do that, or at least keep it in money market, something where it's liquid outside of annuity contracts. Okay. All right. Let me share my screen. So first we're looking at a fixed index annuity with an income rider. Okay. This is one where a client, she's female, she's, it's $320,000 premium, and she's throwing it in at age 58, and she wants to take income at age 65. Okay. Now she wants growth and she wants income. She's going to get both. I'm going to show you how that works. Okay. So if you look at highest income, this is highest guaranteed contractual income. You got ClearSpring, Delaware, Corebridge, and so on. Okay. Pretty good income streams. All right. These are lifetime. They're guaranteed for the rest of her life, no matter what. Okay. So if we look at the illustration, I'm going to show you the good and the bad. Okay. So here's the guaranteed side. Guaranteed side says, they're saying, well, we're going to give you some of the S&P 500. Okay. Subject to a cap or a participation rate. And in this case, we're going to give you 35% of the S&P 500. Okay. So again, this is not a growth product. It's a hybrid. It gives you some growth and some income. Okay, so I'm gonna show you the other ones. Okay, so if we look at 35% and say, all right, well, if the S&P does nothing, if there's no growth, if we have a big recession, then here's what your account balance looks like. Your account balance is going to go down faster. Your income there is guaranteed. That is for the rest of your life. So you take that out, and it's pretty good. I mean, you can see it's like 1.2 million. Okay, it's pretty good. Now if you look at maybe some growth, we're just like, well, if it does grow like this, then your account balance is going to last longer. Okay, you will absolutely receive some growth, because what's happening is you're taking income and you're getting growth, and we're charging you the rider charge, because the rider fee over here, this is what's giving you this lifetime income, and this is what makes the benefit base worth $592,000. No, that's really the true value in these accounts, is you're still getting a hybrid, but it's focused mostly on income. It is really an income product. So when you look at these, they're giving you an 8% roll-up rate after an 8% base bonus. That is guaranteed. So we go right back up and say, okay, how does that reflect on the benefit base? It means $320,000 is guaranteed to grow to $592,000 guaranteed by the time she's 65. And the guaranteed withdrawal rate will be 6.9. And she will get $40,869 per year for the rest of her life. That is guaranteed. Now, what's not guaranteed is the growth, because it's a growth product tied to an index. We don't know what that's going to be. But she's really getting the best of both in this product. She's getting the best income that she can possibly get, and she's getting the best growth that she can possibly get. Now, if you're thinking, well, that's not enough growth. I want my balance to last longer. Okay, I don't want this to run out at all. Do you have anything for that? Yes, we do. Let's take a look. So what we'll do is we'll say, well, we still want lifetime income, but we don't want the fee. Okay, we don't want any fee. So I'm going to click that box. Okay, the fee is what gives you that high roll-up rate, that 8%, okay, the high withdrawal rates, okay? That's what it gives you. It's very, very valuable. But if you're not looking for highest lifetime income and you want more growth, you want the account balance to stick around longer, take away the fee. So we look at that and say, all right, well, income's quite a bit less, but maybe you're not looking for income, okay? If you're not looking for income, then this might be better. So if we're looking at just the highest A-rated, then American Equity is the best. So we'll pull that up, and I'll show you what this looks like. Again, they're going to show you guaranteed versus hypothetical. So guaranteed is worst case. Guaranteed is, well, if there is no growth ever, okay, which is very extreme, by the way, and they're not giving you very much of the S&P. They're giving you 20% of the S&P. So they're showing you if the S&P does nothing, then your account balance is going to run out eventually by the time you're 80. Okay, so it does last longer. It lasts much longer than the other one. Okay, because there are no fees. There's no fees on the right-hand side. You can just see there's just lifetime income. Okay, now they also show you here's what it'll probably do. You're still going to get the same lifetime income, but you're going to get some growth, and your account balance is going to go down a whole lot slower. It's going to last till you're 90. You might be thinking, all right, that's better. I want to make sure that I've got a death benefit that lasts longer for my kids or my beneficiaries. And you can see the death benefit right here. The death benefit on all these lasts as long as the account balance. So this is a hybrid that's more evened out. It gives you less lifetime income and more growth, and the account balance sticks around longer. But in my opinion, it's kind of gives you the worst of both. You've got much lower income. It's almost half, okay? That's quite a bit less. Okay, and then you've got growth. Yes, that's nice. But again, it's not giving you the highest growth that you can possibly get from an indexed annuity. So that's why I always tell people, if you're going to buy, if you want growth and you want highest income, separate it out. Buy one for income only. Buy one for growth only. If you do that, you're going to get higher participation rates in the growth products, like 60% in the S&P 500, okay? It's a whole lot better, okay? And then you still got maximum income, okay? So, all right, so what we're going to do is I'm going to go back here and I say, okay, if I go and I take this back off, so I said, again, the rider fee, yes, I want higher income, John, and I want to do some growth products. Then what we're going to do is we'll just say, all right, well, let's say we want to put $320,000 in this, but I don't want to put as much in the growth. I'll just put another 180. We'll just make this an even $500,000. I've got $1 million in my portfolio. I want to take half of it and protect it, and the other half I'll leave in the market. Okay, great. So we've got part of it, $320K, giving us $40,000 a year guaranteed income. Now we're going to take the other $100K and give us growth. Okay, that's great. So I wanted to show you, though, before we do that, I want to show you the cost of this higher lifetime income, because it's $26,000, or what is it, $23,000 actually, versus let me look here. Was it 20? Yeah, it was $23,763 versus $40,869. So all right, so about $17,000 difference. Now you are being charged some rider charges. See the rider charges here, and they go for as long as the account balance is, which is probably 19 years, but you can see the last few years isn't very much. So if we average that out, and we'll say, well, let's see, 19 years, maybe the average is $3,000 on average. So let's just say 20 years to make my math easy. That is what, $60,000. So $60,000. I was like, okay, well, yeah, I'm paying $60,000 in fees. Dang it. Well, but if I'm taking lifetime income for, let's say, 30 years, and it's an extra $17,000 per year, I'm getting $510,000. So I was all right, $510,000 minus $60,000 total fees. I'm getting a net $450,000 extra for my fees. Probably worth it, right? So if you're looking for highest income, choose the income product, pay the fees, have the highest income. There, you've got that taken care of. Now we go to growth. Okay, so we'll pull up the growth. Let's see here. I want to look at indexed annuities, ones that give you more of the index and still give you 100% market protection. You can still take money out of them. If you want to supplement your income, you can do that. You just need to realize it's not guaranteed. It's not a guaranteed lifetime income product, okay, that a rider will give you, okay? So if I went in here and say, okay, let's see Delaware. I'm pulling them up because I have personal experience with them, and they are great as far as growth products. So go in here, and we'll say, let's see, I want to do the 500, S&P 500. I want to make sure that this is the pure S&P 500, because there are variations. Okay, the S&P 500 or the Mark 500, that's not it doesn't do very well. So, all right, 60% for this particular one, and this is state of Florida. There are different participation rates in different states, but usually it's around 60. So California is 58%, but they only do a 9-year surrender charge period, where this one is a 10-year surrender charge period in other states. So they give you a little bit higher of growth potential, but it's not a huge difference. So we look at this and say, okay, what does it look like? And I got 320,000 in there. I know we're going to say 180, but you can say 320. And this is the guaranteed side. You see, if there's no growth, yeah, they do give you some rewards of leaving the money in there, which is great, but that's not going to happen. This is saying the S&P 500 never recovers. Okay. You go up here and say, okay, that can grow. pretty decent over the next 10 years, grow to what, $737,000 as a growth product. And then you might at that point decide to take out, 20, 30 grand a year to supplement your other annuity. And you just kind of watch the growth. And as long as it keeps on growing and doing well, then you'll just keep on supplementing and your account balance won't run out. It's great. It's a great product. You just have to realize it's not guaranteed. It is absolutely not guaranteed. Okay. That's really, really important to know. Because people will sell these and people will buy them thinking, oh, I'm going to get guaranteed income. It's like, you're not going to get guaranteed income. Okay. You can pull out withdrawals and you probably will pull out a decent amount of withdrawals every year for the rest of your life. But the big word is probably. Okay. What if you have 4 years where there's a recession? You might have a couple years where you don't feel comfortable doing that. Okay. And you just wait. That's fine, because you're not going to lose any money due to a recession. You just won't make anything. So it'll just sit where it is. So when you're looking at growth with FIAs, fixed index annuities, they're buying call options with the S&P 500. If the S&P 500 does well, then you make money. If it doesn't do well, you don't make anything, but you don't lose anything because they're not exercising those call options. Okay. So, all right. So I know I showed you a 320 instead of 180. The 180 does the same thing. It just doesn't grow as much because you got lower premiums. But you can put whatever you want in here. Maybe you only want to put 100 grand in here. That's fine. But what I always recommend is if you want the hybrid approach, you want growth, you want income, separate them out. Okay. You've got the income side. Get the income rider is usually the highest payout, or a SPIA or a DIA. But I would say income rider is probably the best if you want highest annual income. Okay. Get that. Okay. And then get something without the rider, just pure growth. Okay. For the index. Now, with high rates where they are right now, okay, when you're watching this video, that maybe they won't be high, but they are high right now. And so people are buying MYGAs. What are MYGAs? MYGAs are multi-year guaranteed annuities. They're fixed products. Okay. They're paying a lot. So I'm going to show you those real quick. Keep this video as short as I can, but I still want you to see what's available. So I go in here and say, okay, what do we got? Here's the top ones for 2 years and 3 years and so on. Let's say I went, well, I want to get the highest rate for the longest I can get. Okay, well, 10 years, 6%. Well, these ones don't allow withdrawals. I want one to live off the interest maybe. Okay, good. Revol 1, 5.9. There you go for a 10-year. Pretty simple. So for this one, it is guaranteed to be 5.9. So it's not going to make as much over time like a FIA would because you're tied to an index that earns a lot more, but you still got decent rates that is influencing a great growth rate. So if we look at this and say, okay, well, this is going to grow. If I let it sit, it's going to grow to $567,000. Definitely not as high as what the FIA was showing, but still it's pretty good. And if you take the earnings out, let's say you live off the earnings each year, it's $18,880 every year for 10 years. And at the end of it, you get your money back. Otherwise, you can let this thing grow. Maybe you let it grow for 5 years and you strip off 23 grand of interest that year and do that for the rest of the time. And then you've got, $400,000 at the end of it. You can do that too. These are very nice and people buy a lot of these from me. So it just depends what you're looking for. If you're looking for highest growth potential during a longer time period, get the FIA. Okay, get the fixed index annuity and get the right one. Okay, there's only certain companies that I recommend to do that because you want companies that are known to keep their participation rates constant year after year after year. Otherwise, you get one that gives you a high 80% par rate and then they lower it to 30% after that or even lower. You're not going to be happy. Okay, so that's why you got to talk to someone like me who knows which companies to recommend. Okay, all right. I'm not going to push it anymore. If you want to reach out, feel free. Okay, go to my website, johnstevenson.com, see the annuities that are available. And if you want to purchase an annuity, if you're thinking you'd like to purchase one, then please feel free to book a call. There is a link on my website. It goes directly to my calendar. There's a link below this video. You can also go there as well and book a call with me. So happy to answer your questions. If you do have questions, please submit them down below in the comment section. If you like the video, subscribe, share, like the video. And I really appreciate you watching this. I mean, there's a lot of content. There's a lot that I kind of just compressed into one, and that's fine. But I just kind of want to open your eyes so you can kind of see the possibilities of the hybrid and the income and how you can combine it in probably the best way that I would recommend doing so. So anyways, hope that helps. Thank you so much for watching, and we'll see you next time.